6%. Morgan Creek Capital Management, Mark Yusko is here and joining the conversation all morning long. The Hill columnist and Fox News contributor Joe Concha. I can't wait for Joe to weigh in on pretty much everything. And also Verdant's Capital Advisors CEO Leo Kelly. Gentlemen, welcome one and all. Great to see you. Mark, your reaction to these Netflix numbers. That stock was already down 42% year to date, and then boom, it lost an additional quarter of its value in pre-market.
Yeah, it just shows how high valuations were, Dagan, and how painful it can be if you disappoint investors. You know, I think it's a very challenging market across the board. We've been talking about this construct of FANG's bite. It's their nature, and that, you know, FANG, Diamondback Energy, has been a big outperformer relative to the tech stocks. Tech stocks were in, I would say, stupid valuation levels. And I think they're just adjusting to the reality of much slower economic growth, less stimulus, in fact, maybe even negative stimulus in terms of tightening. All that bodes ill for overvalued companies, particularly the high flyers and growth stocks. But you know, Netflix is down less than companies like Peloton and Zoom. It's been real carnage out there underneath the surface.
And Mark, I was looking at, and I just mentioned it, Warner Brothers Discovery, this newly merged entity. It's got about $58 billion in debt. And like a very close confidant of mine just called me on the phone, does not, a couple of days ago, does not work in the financial industry at all, but does work in kind of a content area, and said, why would you merge these two entities and take on that much debt for what? And so how do you think this landscape shakes out in the months and even years to come?
It's such a great insight and such a really important point. You know, you think about debt. Debt has been really easy to refinance and expand in financial repression, right? Interest rates were close to zero, punishing savers at the expense of borrowers. Those days are over. If you bought a bond index fund this year, you're down 10%. You bought a long bond index fund, you're down 20% this year. And so these companies that are highly levered, take this, the Russell 2000 has 40% of its companies could not service their debt with their EBITDA. Forget pay off their debt. They can't even service their debt. And if interest rates rise any material amount, it's going to be a bloodbath for these over-levered companies. Very similar, unfortunately, to what happened in 2001 with WorldCom and Enron. You know, history rhymes. So again, I think that's just a really important insight. And people should get protected. They should look at really stable investment assets. I mean, we came out with an ETF called CSH as a place for people to use arbitrage to make a small return without taking a lot of excess risk in the debt markets.
I want you were talking about in a rising rate environment and a Federal Reserve that is poised to start shrinking that $9 trillion balance sheet. Atlanta and Chicago Fed presidents were speaking yesterday, both saying that raising interest rates will not cause a recession. We'll also hear from Federal Reserve Chair Jay Powell at the International Monetary Fund debate on the global economy tomorrow. Mark, the Fed can they say we're not going to cause a recession? There was unprecedented stimulus, unprecedented balance sheet blowout and money printing, and now they act like they have it under control. Do they?
Dagan, no, that was my hashtag when I was talking about coming on this morning with you. Fed in a box, right? The Fed is in a box. They are powerless against the two things that they fear most. One, inflation. They created the inflation. Well, government spending and money printing created the inflation. It's really not inflation like we think of inflation from the 70s. That's demand pull. This is simply currency debauchement, currency devaluation. That's why prices are rising. And this idea that, so technically, Dagan, they're right. We're not going to cause a recession because we're probably already in the recession. We're probably already feeling the after effects of too much stimulus, too much partying, and the hangover is set to come in. And I think first quarter GDP numbers are going to be close to zero. We're likely to see retrenchment in activity, and we're probably going to have some tough times, particularly if they take liquidity punch bowl away and try to raise rates. I will take the under on that, by the way. Everyone's talking about all these rate hikes. If we get 3 this year, it'll be a miracle.
And what about the balance sheet reduction? So do you think that they really, because balance sheet reduction in layman's terms is destroying money. And what kind of gut do they have for these assets coming back down to earth?
They're the buyer of last resort. And look, they're the buyer of last resort. And who's going to buy these assets? The Chinese aren't going to buy them. The Russians aren't going to buy them. No one's going to buy these assets. So they are going to buy them. Look, Japan in 2007 said they would end QQE. They had a second Q for qualitative and quantitative easing. They had 100% of the balance sheet, or 100% of GDP in debt. Today, they're 226% of GDP in debt. And the Bank of Japan balance sheet has expanded for the last 15 years, even though they said they were going to stop. So, the lady doth protest too much, methinks. No chance the Fed reduces their balance sheet. It will keep expanding. They're trapped. There's no way we could finance the government debt and deficit that we have today at higher interest rates. So they're just going to have to keep buying.
Why is the Fed a lady when the is about to hit the fan?
I was just quoting Shakespeare. I was trying to be cute.
No.
Really,
I'm just giving you a hard time. It's 6:10 in the morning. I deeply appreciate you getting up and talking about all this, Mark. I was just ribbing you a little bit to start.
Oh, that's all right. I'm not a morning person, Dagan, so
Yes,
I do appreciate cutting some slack.
You are for us, Mark Yusko, and I appreciate it. Thank you so much. Great to see you. And we'll post Mark's interview because he dug into a lot that everybody needs to know for the coming weeks and months and years. And we are just getting started this morning.